Good afternoon and good morning, everyone. Welcome to our presentation of today on transfer pricing in the United States. This is Rudolf Sinks, Quantera Global, one of the founding partners. Today with us is Guy Sancharin of WTP Advisors in the United States, who will pick up the majority of the presentation of today. He is accompanied by Jeroen van der Linden, who is founding partner of TGS Limetree in the Netherlands. TGS is connected with WTP through their TGS network, same as Quantera Global as a alliance with WTP. You have seen a short introduction already, so welcome with us. And I'm happy to give the presentation to Guy at this point in time, but not before. It is useful for you all. If you have any question, you can drop this in the questions box that is shown on top of your screen. Just a couple of lines for us to pick things up. If it is not possible to deal with your question throughout the presentation, we'll pick it up afterwards, at least if you have not dialed in on an anonymous basis, that is. Thank you so much for being with us. Over 170 participants, which is really great. Guy, here you go.
Great, thanks Rudolf. And I think we're still hoping that my colleague Kash Mansouri will join us as well. I think he's having some technical difficulties, unfortunately, so I will take over his slides until he can join us. Hopefully he can join us and jump in here. So thanks for joining us here, and thank you to QG Academy for hosting this great event. We have a fantastic list of participants here from all over the world across several continents, so that's great. With that in mind, we have a very diverse group. So we are going to start with introductions, of course, and then we'll talk about the US tax environment and some basics on US transfer pricing. And for those of you that are already very experienced with US transfer pricing, bear with us because we'll get into some more technical content later on. But we thought it would be important to at least cover some of the basics to give a foundation for everybody. Let's talk about the US tax environment, the US transfer pricing, and then talk about some things we can do in COVID and in the BEPS environment. Next slide, please. So before we jump in, I'll just give you a quick overview of WTP Advisors. We are a US-based boutique international tax and transfer pricing services firm. We cover the globe through our relationships with Quantera Global and the TGS Global Network membership. And we provide clients with personalized service with direct involvement of our most experienced professionals, which I really appreciate the opportunity to do. We do not use the leverage model. We are very intimate with our clients in terms of working with them, and we often become an extension of their teams. Jeroen, could you talk a little bit about TGS Limetree, please?
Yes, I can. Good morning, everyone. Good afternoon or good evening. My name is Jeroen van der Linden. I'm the founder, as Rudolf said, of TGS Limetree. We have a boutique firm specialized in international taxation in the city center of Amsterdam, the Netherlands. We have been, as from the start of our firm, we have been member of TGS Global, an international network of independent tax advisory and accounting firms. And through that network, we have a US representation with WTP Advisors. And so we are fellow TGS members, and we in the past we have been working with Quantera also on a special occasion in the Netherlands. So we are it's nice to do a presentation with each other. Most of the talking will be done by Guy today, but where possible I will step in or help him. Okay, and I hope you enjoy your presentation today.
Great. So good old Ben Franklin, not only does he appear on our US dollar bill and is famous for his exploits in understanding electricity, he has also this famous quote, which is, in this world, nothing is certain but death and taxes. So with that said, let's go to the next slide and talk about the US tax environment. Just very briefly, US tax rates will likely increase here as we strive to try to pay for the increasing debt and the impact of COVID. The current US federal income tax rate is 21%. It was 35% before the recent reform, recent law. The proposed rate is 28%, and we expect some kind of compromise in the range of 24 to 26%. Now, it's important to note for those of you that are outside the US especially, that the US state income taxes are in existence as well. And those rates range from 0 in some states like Nevada and Wyoming, all the way up to 12% in Iowa and everything in between. So in terms of tax planning, it's important to understand that in terms of your tax obligations. We expect more audits and more controversy across in the IRS as well as states. The IRS is in the process of getting better funding, and they're hiring like crazy, including some of my friends have been hired by the IRS, and this is definitely an interesting situation for them to get into the trenches and understand transfer pricing from the tax authority perspective. There's also increasing transparency, as a lot of you know already, through BEPS. Through ASC 740-10 in the US, which requires disclosures that provide tax authorities with information that they can use in their assessments of whether there's other opportunities for them to increase taxable income in the US. Jeroen, why don't you talk a little bit about the Dutch tax environment?
Well, we like in the US, we recently had elections, although our elections were from March. But we don't have a cabinet yet. At the moment, where 7 parties are talking about forming a new cabinet. It is, and therefore, like in the US, it's still uncertain what the rates will be. The tax rates could be the coming years. At present, we have 2 rates, the 15% rate and a 25% corporate income tax rate. But due to the COVID crisis, and who's going to pay the bill? Probably the taxpayer. The rates are uncertain for the coming years. And what we see is that there was a report published last year with building blocks. And with that, the Dutch politics can pick out some suggestions made by public servants to improve the tax system. And one of the suggestions was also to change the current tax system or tax rate in the Netherlands, and instead of using 2 rates, going back to 1 rate. So I would not be surprised if, as from the 1st of January 2022, the Netherlands will not have 2 rates anymore, but only 1. And I expect that the 15% rate will increase to approximately 20 or 21%. But again, we are still negotiating. We don't have a cabinet yet. So we'll see what happens. Yeah. Okay, Guy.
Great. Let's go to the next slide, Jan. So thank you. We think it's important to understand the context of different tax regimes, and we thought that would be a good setting to jump into the transfer pricing area here now. So let's just go through US transfer pricing very briefly and quickly here through the next series of slides. So the US has one of the oldest and most mature transfer pricing regimes in the world. The basis is Internal Revenue Code Section 482, which is implemented through our Treasury regulations, which are very comprehensive regulations, 1.482-1 through -9. And we'll talk a little bit more detail about those here shortly. We also have penalties in the US under IRC 6662 and the Treasury regulations that talk about when those penalties apply. And I'll also talk a little bit about that as well. Next slide. So here is a structure of the US transfer pricing regulations. And if I were to compare these with the OECD guidelines, I would generally say they tend to be more prescriptive, very specific. So we've underlined some key words here. So -1 is sort of an overview that sets the stage for the rest of the regulations on what the arm's length standard is. Then if you move into the rest of the regulations, for example, in -3, specifies specifically what kind of methods apply to tangible property transactions. -4 talks about intangible property. -9 talks about services. And then strangely, the different parts of the regulations go into different areas that are important from a U.S. transfer pricing perspective. -5 and -6 talk about methods. -5 talks about the comparable profits method, which is the method, tends to be the method of choice, rightly or wrongly in the U.S. Of course, we'll talk a little later about the best method rule, and of course other methods do apply in some situations, but a lot of times we really look at the comparable profits method as sort of a kind of the method that is easiest a lot of times to apply and understand. And then the profit split method in -6. Next slide. So very specifically in the US regulations, controlled transactions are defined as any kind of control, direct or indirect, between two or more taxpayers acting in concert with a common goal or purpose. A presumption of control arises if income or deductions have been arbitrarily shifted. I just wanted to highlight this because although we think about transfer pricing and being applicable to situations involving affiliates of a global group, here we could technically look at unrelated parties being subject to transfer pricing rules as well. Think about joint venture partners, for example, or even any situation where if the IRS can show that there was an acting in concert with a common goal of purpose of reducing taxable income, they could pull in the 482 rules to impose adjustments. Next slide. Let me just go through the arm's length standard as well here. Early on in my career, I was fortunate enough to do a 3-year assignment in Belgium, and it really gave me a good understanding of sort of the differences between the arm's length standard under the US regulations, which focuses on results. I've underlined results there 3 times in the definition of arm's length standard. Whereas one of the things I learned more and more about in my assignment was, it's not just results. It's also behavior is also important. It's important to have intercompany agreements in the U.S. as well and follow those intercompany agreements. But even more emphasized in the OECD type landscape is that that the behavior between the parties is also important. That's, I think in some sense, one of the things I learned is that transfer pricing can be a reflection of our cultures, both the rules as well as the practices around the rules can be a reflection of how cultures operate. And the US generally is more of a results-oriented culture than a lot of other countries in Europe and other countries as well. So we have to keep that in mind as we look at managing our transfer pricing risks and planning. Next slide. So we do have, as I mentioned earlier, transfer pricing penalties in the US. There are 2 different types of penalty rates, as well as 2 different types of penalties. The penalty rates are the substantial valuation penalty and the gross valuation penalty, and those bring with them significantly different rates. One's at 20% level, and the second is at a 40% level. And I'll talk about more about that here shortly. There are 2 different penalties. There are penalties that are focused on individual transactions, and also penalties that are associated with the net adjustment. So a group of adjustments. So the first one is a transactional penalty pertaining to adjustments in a single transactional, and the second is a group of adjustments. I'm sorry, I'm speaking there a little bit. Generally, to reduce the risk of a penalty for taxpayers, we should establish the arm's length nature of the intercompany pricing policies. And a great way to do that would be creating and maintaining contemporaneous documentation, although in a lot of situations it's not necessary and perhaps might be overkill for smaller transactions. But generally that's the procedure or the approach to manage penalties in the US. Next slide. So this graphic illustrates how the transactional penalty works. So again, the transactional penalty relates to an individual valuation misstatement, but the hurdle to cross over in order to get that penalty to overcome that penalty is lower than the net adjustment penalty. Here, a taxpayer only has to prove that they had reasonable cause or they acted in good faith. And for example, a simple benchmarking study might help a company kind of overcome this. And if they can show that they had reasonable cause and they acted in good faith, the transactional penalty does not apply. However, if they can't overcome that hurdle, then the question is whether the transfer price was over 200% or less than 50% of the correct price. So if it doesn't meet that criteria, then the transaction penalty does not apply. Sorry. If it does meet that criteria, then the next question is whether it was greater than 400% or less than 25% of the correct price. If no, then the substantial valuation misstatement of 20% of the tax underpayment applies, plus interest. If it does, then the gross valuation misstatement applies. That rate is 40%. So if you think about that situation, it could apply, for example, if there was no transaction in place and there should have been one, then conceptually the gross valuation misstatement would apply to those new imputed transactions that the IRS might discover. Next slide. So the net adjustment penalty has to do with one or more valuation misstatements. And in this case, the way to overcome this penalty is to have contemporaneous 6662 documentation in place. And if you have that in place and it's quality documentation and it meets the requirements of 6662, then the net adjustment penalty does not apply. But if you don't have documentation in place, then if the net adjustments related to the transactions, a group of transactions, exceeds 5 million or 10% of gross receipts, then the penalties can kick in. And at that point, we need to determine whether they exceed 20 million or 20% of gross receipts. If they reach that higher threshold, then there's a gross valuation misstatement. If it's above 5 million or 10%, but below 20 million and 20%, then the substantial valuation misstatement of 20% applies. Next slide. And here, I'm not going to go through these in detail, and a lot of you are probably already familiar with this, but these are the 6662 documentation requirements. There are 10 items here, and these are in place now. I have not seen anything about any sort of local file approach to this, although we do help clients use a local file and adapt a local file to meet the 6062 documentation requirements. These are fully in place right now. Next slide. So let's move into some of the nuances, additional nuances. I've already been talking about some of our differences with OECD, but let's go through a few more here in more detail. The first one is, again, to go with our culture. Early on in my career, transfer pricing was often referred to as the full employment program for PhD economists. They could either be professors or they could go and be transfer pricing specialists in the US. I don't see a lot of that outside the US. I do see certain countries. I think Germany uses PhD economists more than other countries. And certainly the US, a lot of times they're looking for PhD economists to, for example, serve as expert witnesses on either side of a dispute. So we see a prevalent use of PhD economists. My colleague Cash is a PhD economist, and it's great to have him on our team. And he does bring some different perspectives, and we work very well together with him to provide additional perspectives on transfer pricing. Secondly, bundling. This is explicitly allowed and perhaps even encouraged in US transfer pricing. The US regulations specifically talk about bundling transactions. Services transactions can be bundled with intangible property, intangible goods. It goes along with applying the CPM. And so a lot of times what we'll see is an IP owner that has providing services bundled with IP and tangible goods to a service recipient. That's kind of more of a routine entity. Then the natural tendency would be to test the results of the routine entity and make sure it falls within an arm's length range of results for that entity. So we frequently see that kind of setup in the US. That may not go so well with other countries. So, you know, one of the themes of this discussion is, yes, this works in the US, but we also have to look at the other side of the transaction to make sure that we're managing all the risks on the other side of the transaction. We're going to talk a little bit more detail here later about intangible development activities versus DEMPI functions. Is there a difference? We'll talk a little bit more about that a little later here. One of our kind of, maybe it's more words than anything else, but selection of the best method versus most appropriate method. We very specifically in US regulations, companies and the 6662 documentation requirements require us to go through a best method analysis. Whereas in the OECD guidelines, the discussion is around sort of the most appropriate method. So there's a little bit of a difference there in terms of approach. Oftentimes a best method analysis can be done in conjunction with talking about a method being most appropriate as well. So they don't necessarily contradict each other, but there is some language here to talk about. And if, for example, a company is using documentation that talks about a most appropriate method, that might not be sufficient enough for the IRS in terms of the best method analysis. And then lastly on this list here, the CPM versus the TNMM. The CPM is defined as looking at sort of the results of the entities, whereas the TNMM technically is looking at transactions. And oftentimes in practice, we see the TNMM operate very similarly to the CPM, and it works fine. But generally, there is a distinction between the methods and how they're defined in the regulations and the guidelines. In practice, there tends to be a convergence around the application of these two methods. Countries are all over the board in terms of how to test, how to run the test of the CPM or TNMM analysis. The US has its own sort of practices, and then the regulations talk about tests. Generally, the proper technique is to whatever number of years you're using to test the transaction, let's say it's 3 years, you need to use the same number of years for the tested party data to test against the same number of years for the comparables data. There are exceptions. For example, if you're outside the range on the 3-year basis, you can take a look at the 1-year results and do that comparison as well. But generally, our tests are on this, the like and like years. That contrasts, all the countries are all over the board in this, I found. And some countries look at Canada as a classic example of a country that tends to look at the latest year results versus the latest year tested party results. And then other countries look at multiple years versus single years. We did a comparative analysis on this a couple of years ago, and it was really interesting to see the disparity between countries. We're going to talk in a minute about the interquartile range versus the statistical quartile, which are not really specified. So the CPM does not really specify using the interquartile range in the discussion of the CPM itself, but in the examples that are in the CPM regulations and throughout the US regulations, the interquartile range is used prevalently and consistently throughout. So we tend to use the interquartile range. And for those of you on the call that use the quartile function in Excel, I'm just going to say you're doing it wrong. No, I'm just kidding. I'll back away from that statement. But there is a difference between the interquartile range and the Excel quartile formula that you use. And it's important to understand that because that can create some issues. Next slide, please, Jan. So here's a chart that we created. It has lots of numbers, so we love that. Just to compare, I mean, this is very illustrative. On the right there, I've listed out a definition of what the interquartile range is written right in the regulations. It's basically the middle 50% of observations. And throughout this chart, we've highlighted in green what the interquartile range would look like under the definition in 482. And it's very simple. It's either one of the results of the comparables or a midpoint. You see two cells highlighted, for example, in set 7, that's where we see two cells highlighted there. Great. Yeah. So there you have 0.5% and 2.7%. So in those situations, then it's in the midpoint between those values under the IRS quartile. So and if you look at the bottom chart, the circled numbers there, and in the formula at the bottom, you see there that the 1.6% is simply the midpoint or the average between the 0.5% and the 2.7%. The Excel quartile I find more difficult to understand and will always lead to a narrower range, more importantly. So if you're a foreign company that has a US affiliate and you're using the quartile function, you might think you're outside the range using the Excel quartile formula, but you might not be if you use the IQR in the US. So it's important to understand that. We do have there, as shown in the lower right, an IQR plugin that we can send you if you would like. So send me an email after this if you'd like that plugin. I'd be happy to send that to you. Unfortunately, I don't know why Excel doesn't have a formula like the quartile to perform the interquartile range as defined in the US. As I've done some research around that, it's not an unusual approach to defining quartiles. In fact, I would say the Excel quartile function is a little bit more esoteric, a little different than what you would normally see. But anyway, until Excel has that, there is this plugin we can use. Next slide, please, Jan. So intangible development activities versus DEMPI functions. I thought this would be an interesting thing to talk about very briefly. Intangible development activities are defined in the cost sharing regulations. And I'm talking about cost sharing, even though cost sharing might not be applicable to a certain company or certain transactions. Whenever the Treasury and the IRS bring out new concepts, they might apply to other transactions. So it's generally thought of that whatever concepts are brought in the cost sharing regulations apply generally to intangibles transactions. So within the US cost sharing regulations, they define intangible development activities as any activity that could contribute to developing reasonably anticipated cost shared intangibles. So any activity where the output is an intangible. I think it's the IDA, when I think about it, I think it is more sort of an output, the output of these activities is an intangible, whereas DEMPI, it's that plus management and protection and exploitation. In the context of an IDA, potentially maintenance and protection could also apply, but development enhancement certainly do. Those would be at the heart of an IDA. The rest is, to be determined based on the facts and circumstances of what we're looking at. But certainly, I think of DEMPI as a broader concept than an intangible development activity. Next slide. So here, just to dip into a little bit of the U.S. transfer pricing landscape, it's complicated in the sense that every state kind of has different tax regimes. Some states use 482, other states have their own transfer pricing rules. For a lot of the states, transfer pricing, frankly, doesn't matter. They're combined reporting. So the states that are highlighted in blue there tend to be combined, and where transfer pricing typically doesn't come into play, although it could still if they have if there are multiple groups where there are transactions between combined groups. But generally, the red states, the states highlighted in red, would be where they're considered the separate return states, where transfer pricing definitely matters. There are a lot of special rules there in those states, and some states automatically add back royalties, for example. So that would could obviously in many cases contradict 482, but they just automatically add it back. So you're out of luck there if you're trying to charge a royalty. States are arming themselves with more transfer pricing knowledge. Several years ago, I attended a meeting with the group that's Multi-State Tax Commission, and they tend to actually look more at to the OECD guidelines in a lot of cases than the 482 regulations. They were very interested in learning about the OECD guidelines. Next slide. I'm just going to go through a simple example here of how an actual adjustment could take place involving U.S. multinationals. So here in this example, we have a principal, which is an entrepreneur, selling tangible goods to its distributor in Germany, a routine distributor. That routine distributor sells goods to third-party customers in Germany, and it's about 50 million here. Next. So we perform a transfer pricing analysis, and we determine an arm's length range of operating margins. In this case, the range was 1.5 to 4.7%. Then we compared that with the results, the 3-year results of the entity. And the result here was a 7.5% operating margin. So then the question is there a transfer pricing risk? And the answer is yes. In this situation, the IRS has the authority to adjust to the median when the results are outside the range. And so that adjustment would be 7.5% minus 2.8% times 50 million, which equates to 2.35 million in this case. There could be penalties and interest, but if you look at the test here, they're underneath the threshold of the 5 million or 10% of gross receipts. So in this case, on this adjustment, penalties wouldn't apply. If there are other adjustments, which are unlikely in this situation, but if there were to be other adjustments, then potentially we could be getting closer to the penalty rate ranges. There is some flexibility around all this, of course. Transfer pricing is a facts-based determination, so there could be some additional questions where, why did the distributor's results fall above the range? Did it overperform? Can we perform an adjustment that shows that there is a justification for the affiliate to be outside the range? But whenever we're operating with, going outside, it's always better to be in the range if possible, because then we have to jump through hoops to determine whether or not that's the case. And of course, there'll be skepticism on the other side of that discussion. So you have to do quite a bit more work there to justify that. Next slide. Just wanted to talk a little bit here at this point too and mention about intercompany loans, because we see a lot of situations where companies are sending cash haphazardly to other entities or receiving cash into the US or sending cash out of the US. They intend it to be a loan, but they don't really put in place all the things that they need to do to make sure that they have that characterization. So whenever these intercompany financing, intercompany loans, the arm's length standard applies. However, we do have a safe haven, which I will talk about here shortly. So that goes against, it's technically, meant to be consistent with the arm's length standard, but certainly cannot be. As many times you have a safe haven that can be make it easier for taxpayers to apply to requirements, but also puts a little tension on the arm's length standard. As I mentioned before, it's essential to establish the characterization of a transaction as a loan, if that's what the company wants the transaction to be, versus a capital contribution. Next. And I'm not going to go through each of these, but here you'll have the slide deck after this for reference. So use this as a reference. There are specific factors that tax authorities use, that we use, to help establish whether or not a transaction is debt versus equity. Next slide. And these are the 13 here we've listed on this slide. As going through this list here, we note that the BEPS transfer pricing guidance on financial transactions is largely consistent with this. So it's always nice when there's convergence between different regimes in the OECD guidelines and the US regulations and the US transfer pricing in practice. But there, when you review court cases involving debt versus equity analyses, the PepsiCo case and the Laidlaw case, the courts will go through each one of these factors and do an assessment of whether the transaction looks like debt versus equity. And a lot of times it'll be a mix, right? So if you look, what the courts do is they'll say number 9 looks like equity, number 10 looks like equity, number 11 looks like debt. And if they look at the totality of all the factors, they'll make a determination of, based on all these factors put together, it's equity, and then your interests or deductions are denied. So that's definitely something that companies need to pay attention to. Next.
Yeah, this part, Guy. The trouble is, if in the US it has been determined by court or in another way whether a loan functions as equity, in the Netherlands we still have our own qualification, irrespective how the US approaches that. So it could very well be that in the US it's characterized as equity, where in the Netherlands it's a loan. Therefore, we have our own standards, and the main rule is that in the Netherlands a loan is a loan if it's considered a loan for civil law purposes, and we do have 3 main exceptions. And if it's clear from the outset that it's not a loan, a sham loan, or if you're funding and let's say a subsidiary which is enormously loss making. So yeah, you cannot. It's not a serious loan. Then it will function as equity for tax purposes. Or if you provide for a hybrid loan, a profit participating loan, then it will be qualified as equity for Dutch tax purposes, and not if the US court does so, from a Dutch point of view, of course.
That's right. Thanks, Jeroen. And I don't think this is all that inconsistent with how the U.S. would look at things too. I really appreciate the bottomless well. We would call it I think a bottomless pit.
Yeah, we had a discussion of bottomless pit or well. Yeah.
Yes,
we call it in good Dutch a bottomless put. And
I prefer well.
Yeah. Okay. There you go. Yeah.
Water. Next slide. All right. So with that theme, with the buoy here in the tax safe haven and some water. Here, this is a summary of the safe haven rates in the U.S. So there are three different terms specified. There's a short-term AF rate, 3 years or less, and then the mid-term is over 3 years but less than 9 years, and then over 9 years you use the long-term AFR. AFR stands for applicable federal rates. These are rates that are published by the IRS, and you can find them online here. They're published every month. So for transfer pricing, the safe haven is 100% to 130% of the AFR, the applicable federal rate. And you note that the safe haven doesn't apply for the following: if the lender is in the business of making loans, or if the interest is expressed in a currency other than US dollars. So I often, if a company can have flexibility and if they would like to use the AFR, I often encourage them to try to denominate the loans and the interest in US dollars, just to be able to get that. Oftentimes it simplifies. You can imagine, do I want to spend a ton of money doing interest rate benchmarking study or a full transfer pricing study on the loan, or can we just use the safe haven rate? Obviously, there's the other side of the transaction as well. So, but for example, we just recently had a client that has a loan to Brazil, and certainly the U.S. loaning money to Brazil, if you're using the AFR in that transaction, it certainly doesn't feel like it would be arm's length to use the AFR in that situation, given the Brazilian environment. Certainly the Brazilian side is probably happy with that low rate. And then, of course, we're using a safe haven in the U.S., so that's a perfect situation where it could be a very practical and very, very valuable use of the AFR. If, however, a company, I'll just name any country that has maybe high interest rates, where they're loaning to the US and you're using the AFR and the safe haven payment from the US to that country, the AFR may not be appropriate from that country's perspective. So it's important to consider that. Next. So here's kind of showing exactly what the AFR is. The location of this publication is shown here in the lower right on the IRS site. So in this situation here, the AFR is published in May 2021. The ranges here are shown. Obviously, the short-term rates are very low, 0.13 to 0.17%. The midterm rates are substantially higher, 1.07 to 1.39, and then the long-term rates are higher, with 2.14 to 2.78. So again, the issues here is there's no credit rating issue here. So if an entity has a low credit rating, technically it might not be arm's length to use the AFR, but you have the safe harbor, so it would be fine from a U.S. perspective. And again, one of the other questions is, will a tax authority accept the AFR from their perspective? Next. So let's talk about BEPS. As everybody knows, BEPS stands for, next, Belgian Equine Practitioner Society. So for the rest of the discussion, we're going to talk about horses. Actually, we'll talk about base erosion, profit shifting. But when I Googled BEPS, several years ago, when the OECD came out with BEPS, you Googled BEPS and the Belgian Equine Practitioner Society came up, and I thought that was interesting. It also ties into my experience in Belgium, and I appreciate horses. So, but base erosion, profit shifting, the U.S. is participating in that. I was talking with some of my friends who are working in the IRS about it, and it's kind of interesting because they are, quote, BEPS aware, but they aren't necessarily implementing all the things in BEPS. I mean, they want to be understand it, but it's really about the U.S. regulations. So again, we haven't really adopted the master file, local file approach, but what I do is when I prepare what I would call a US local file under that structure, I would prepare a US local file that specifically lists the 10 principal documentation requirements and then specifically indicates where in the master file or the local file that documentation is located. And that's how I structure this practically for a company that really wants to have globally consistent transfer pricing. It's nice to be able to use the master file, local file approach and achieve compliance at the same time. So we're weighing those things, and that's how we've been able to successfully do that. Next. So, but one thing that the US has implemented in BEPS is CBC reporting, and that takes the form of IRS Form 8975. Schedule A has all the details here, as shown here on this slide. You could see that this template, this form, is very much in line with the template in the OECD guidance on Action 13. So it's basically all the same information. And it's just a matter of completing this. And next slide, please. The next bullet. So here, just mention that 850 million is the threshold for U.S. multinationals. So 850 million plus in the preceding year, that would trigger CBC reporting requirement in the following year. That's very similar to the global practice, global standards. Next slide. So now with all that said, what do we do in this COVID environment? And when I think about that and look at the landscape, a lot of companies have losses, which is difficult, right? I mean, the problem with a company with losses is you've got losses. So how do you deal with that? Do you have to have profits in some countries and losses in others? That just drives up your tax burden and your effective tax rate. You might have to because you have a transfer pricing policy that's in your requirements in various countries that is more rigid than maybe others. But if you can have some flexibility there, and I think that in transfer pricing, you know, one of the first things I learned when I first started 20 plus years ago was that it's as much of an art as it is a science. And so if we can come up with logic and business rationale, it may be appropriate to target zero returns across the value chain to try to minimize having losses everywhere and then profits in everywhere and then a loss in the entrepreneurial entities. So it may be appropriate. You'd have to take a look at the facts and circumstances and look at the appetite for risk of the company and also how tax authorities are treating these. Some tax authorities are more practical than others. So then we would look at potentially looking at the impact of reduced volumes and whether for example, if it's a principal company that has routine distributors, are those routine distributors managing their costs? And if they're not, then maybe that's an opportunity to take a look at and see if they have higher costs than they should, if they haven't reduced their operating expenses like they should have. Maybe that's an analysis that can be done to show that distributor can fall below the range or at zero. But the IRS will be skeptical. So be careful, you know, make sure the logic sticks together really well. Next. So then we have M&Es that were not heavily impacted. And I would say for those companies, steady as she goes. But then there are, you know, in any environment where there's some kind of impact, your economic changes creates issues and then also opportunities for other countries where there are winners and losers. So the winners here, I just want to say that what I've heard from my sources at the IRS is the IRS knows you exist. So make sure you're following through with your transfer pricing policy and taking that into account. They are aware that and are looking for companies that have higher returns overall. So take that into account when you're doing your transfer pricing planning. Next. So here's an example of what we thought of in terms of a potential COVID adjustment example, and it might be less related to COVID as it is to some kind of issue that the company might have had with fraud or something that happened, or some kind of event that caused sales volumes to go down. So in this case, we had a situation where the tested party results are 2018 to 2020 was 1.5% operating margin. And so that failed the 3-year test, and then it also fails the single-year test because it had a negative 0.5% operating margin. And this company has an overall loss. So that's part of the explanation of the results here of the company. Next. So this highlights the range. And again, we're going back to the, there's a difference between the IRS quartile range versus the Excel quartile. So in this instance, the 3-year interquartile range is 2.1 to 7.6%, which is wider than the Excel range of 2.5 to 7.3%. Next. So the adjustment here we did to the comparables is that because our client had a 20% reduction in revenues and a 15% reduction in COGS, we factor that into the comparables results to determine adjusted results for the comparables, which drove a lot of them results to obviously lower or even negative operating margins. And what this analysis did was to reduce both the 3-year and the latest single year results to where the lower quartile is negative and the upper quartile is a lower positive number. So reduce the range. And so now with this adjustment, we can show that the tested party is within the range. So obviously this is very facts and circumstances, but I just wanted to kind of illustrate how we might do some adjustments in the US for COVID or for extraordinary situations that might call for such an adjustment. Next. We put together a few slides here, and these were slides that my colleague Cash was going to go through. So I'm just going to give some very high level because I think we're approaching the end of our discussion here anyway. So I just wanted to let everybody know that my sources at the IRS say there's a lot of buzz within the IRS on the Coca-Cola case. They were very pleased with this IRS win, and it really gave them heightened morale within the IRS that they were able to bring a successful conclusion on some adjustments. I would say that Coca-Cola, one of the things is that to make sure that a lot of times companies place a lot of reliance on the past, which is good. It's always important to understand, and past precedent can take into place, but things change, and a prior arrangement or prior situation that was okay in the past, things change, rules change, the economy changes. So it's dangerous to rely on the past audit history in the future. And it's also important to understand how the intangibles relate to the value chain, and certainly a DEMPI analysis would have been helpful here for all the parties, for Coca-Cola to have done in advance to actually put itself in better situation in the facts, because it had segregated its functions so much. It gave the IRS the opportunity to say, you know what, these entities operate more as routine entities. We can use a CPM to test them. And therefore, we were able to use these CPM analysis as opposed to the cuts that Coca-Cola was trying to use to try to justify more than routine profit for the entities. So let's skip over. So this summary slide is in the slide deck, and this one is as well. I'll let you guys read these and let us know if you have any questions or comments on these. But these are the Coca-Cola case and the Altura case are very important recent cases that we should pay attention to. Next. So at this point, I'll turn it over back to Rudolph. Thank you, everybody. I appreciate the time here that you're taking. And again, feel free to contact us if you have any questions.
Thank you very much, Guy and Jeroen, for sharing your comments with us. Thank you so much, Jan, for arranging the technique around the webinar of today. Indeed, ladies and gentlemen, it has been a pleasure to welcome you on board. With over 170 participants, this really stands out also in our series of webinars so far. So it's really great to have had you around. Selection of our upcoming webinars, there's a lot more after mid-June, but these are the next ones. Already tomorrow there's entity management and transfer pricing. That means tooling equipment around transfer pricing, how to use it, how this can make your life easier. If you have not dealt with tooling before, but would like to catch a glimpse of what it can mean to you, then you're certainly welcome to participate. 8th of June already, there's Tax and Treasury. It takes two to tango, where we will share our thoughts together with the ING Bank, Zenders and A.S. Watson. Our thoughts on the wonderful combination indeed of tax and treasury. You can see that that combination in corporate entities typically is being dealt with one tax director who is also dealing with treasury, but it can also be split. We will certainly take a deep dive into the treasury part as well, with a transfer pricing angle for certain. More than welcome, and also if you have not caught up yet on the latest OECD developments on financial transactions, you're more than invited to participate. 17th of June then, transfer pricing risk management, out of our series of controversy measures that you can take. I think Guy in his presentation of today shared with us some simple measures to stay away from penalties out of US. Obviously there's a large variety of ways to deal with that also across countries. And we will typically dive into the APA and MAP programs together with you. If you have any other thought of a webinar with a transfer pricing angle, then please do let us know. You can register on any of these webinars in the email address noted here below or through our website. If you have any idea for a next webinar, perhaps after the summer break, for us to pick up, then you're more than welcome to share your thoughts with us. So again, thank you so much all for being with us. We were happy to provide you with the latest update of the US impact on transfer pricing. Thank you so much, Guy. Thank you so much, Jeroen, for sharing your thoughts. Thank you, everyone. Till next time.
Bye, everybody.